Good day, everyone. This is Jason Trennert, Chairman and CEO of Strategas, the investment strategy arm of Baird. As the volatility in both the equity and fixed income markets persists, I wanted to take a brief moment to talk through how we're thinking about things and what our outlook for the remainder of the year looks like. I think it's very likely that the high volatility market that we've seen so far is likely to continue, and that's largely because I don't think the Fed is anywhere near its neutral rate. As we know, inflation is running over 8% based on the CPI, and the Fed funds rate is only 0.75%, 75 basis points. So I think there's a lot more room for the Fed to tighten. And I also think there are going to be increased concerns about the potential of recession next year. I think those things taken together will make this for continued to be a very volatile year for the financial markets. Well, the Fed certainly has an opportunity to stick the landing, although I think the longer inflation goes, the more difficult it is to rein in, and it's a moving target. History has shown us that. The Fed is starting to get aggressive, but I think it's also important to note that the Fed was buying securities as late as March 11th, so the Fed was actually easing as late as 2 months ago. And so I think their problems are somewhat compounded by the late start that they've got. You also continue to have supply chain issues, and you still have an enormous amount of monetary stimulus in the system. There are also discussions about various states and localities providing some sort of stimulus to consumers in an effort to counteract inflation. Unfortunately, I think a lot of those efforts will prove to be counterproductive. As far as the geopolitical tensions are concerned, we think the greatest potential economic impact is that the tailwind for disinflation that we've seen since 2001 is likely over. It's difficult to describe globalization as dead, but I do think that there are a lot of concerns now and a lot of thinking about whether increased trade has made other countries more Western. And I think there's a lot of skepticism around that now after the pandemic and also given the war in Ukraine. So a good portion of the so-called peace dividend that we received really since the early 2000s, in our opinion, is going to go the other way. So that's how we're mainly thinking about the geopolitical concerns and the way they could impact inflation and, by extension, bond yields and earnings multiples. Well, listen, I think earnings estimates for next year for the S&P 500 are up a lot, about $250. We have them at more like $235 for next year, and I would say even that may be somewhat optimistic. The labor market is tight as a drum, but we do think that at the margin, margin pressures are going to make it more difficult for companies to continue to add workers at the pace at which they have in the past. And so we do think a combination of both higher inflation, Fed tightening, and weaker labor markets should increase concerns about a recession. That doesn't make a recession a foregone conclusion, it just increases the odds. And I think a lot of that really stems from the Fed's policy mistake in letting inflation get out of control. Well, I think we feel very strongly that given these concerns that customers should really stay pretty close to home in terms of their equity investments, which is to say stick with very high quality names, companies that trade as a multiple of earnings and cash flows as opposed to a multiple of sales, and that are also willing to distribute cash back to shareholders via either dividends or share repurchases. We would be very, very careful, given our concerns about inflation, about companies that don't return money to shareholders and that are trading as a multiple of sales. I want to end by saying I very much appreciate your time, and I hope this has been helpful. Know that we'll keep a close eye on things as they evolve, and be sure to reach out to your Baird advisor if you have any additional questions or concerns. Thanks again.